I'll go last. I'll go wherever you want me. I'm feeling
Doesn't
laid
really
back
matter.
and
What are
all
you talking about,
chocolate
Jeff?
loaded up.
We're live, just so you know.
I want to talk about On Cloud.
Where are you?
Swiss running
so
juggernaut on Cloud, on holding. And Zendaya.
I suggest we start with
Ben, if you just want something to look at to get into shoes, go look at her. It's the most beautiful website I've ever seen. She's gorgeous. She's incredible. And they actually have the shoes out already. Yeah, it's really cool.
That was such a land for them. What a coup to sign her. Perfect person to sign. Robert, before we get to shoes, Robert, you were going to say about Chart Industries. What did it report?
Well, they reported a small beat adjusted for non-recurrings, and the shorts are screwed, so it's up $15. So it's good having short interest
Yes, when you're right.
That's what I wanted to point out. But
yeah,
that was one of your questions. Yes, when you're right. So just don't be wrong.
Yeah.
There's an easy way to avoid stock if you're wrong. Don't be wrong.
Well. It's about what trading window you're in, right? What's the trading horizon? I mean, I'm pretty sure that DJT shorts will ultimately be proven to be right, but there's a lot of periods of pain of feeling wrong, if you will.
There've already been like 2 opportunities to make massive money on the short side there. It just.
Well, the last 2 days was 40% down.
Yeah, you're talking to somebody who had like slightly out of the money puts that expired a week before the first time it collapsed, and I didn't roll them because I was like, I've lost too much money on this. So.
Well, it's a 250 implied vol. That's a very expensive game to play. Like very, very difficult.
Yeah, well, Well,
the dealers are very well aware.
I was selling vol with my buying vol, but I was net long vol.
Okay,
yes.
all right.
We have a family friend, a buddy of my kids, who wants to ask me about stocks all the time, and he wants to talk earnestly about DJT all the time, just because he's kind of a Trump fan, and it's just heartbreaking because it's just like, yeah, son, this is, the word scam gets tossed around a lot on Wall Street, but this one here is kind of what they look like, it's because I want to know what he can learn from it, what the financials mean, and it's like, we don't really apply those to companies like this. That's not what this game's about.
Indeed. All right, let's go. Jeff, Berna, Robert. How's that sound?
Perfect.
Yeah, and John, if we want to, I don't know if you saw the graph I did, but that would introduce kind of the entire concept I'm going to have. It's going to be just a year.
I have it.
Lazy Friday, victory lap. Holy shit, the trade of the year has been short Nike and buy almost anything else.
You were the king on that, buddy. Great call. That was a great call.
And kind of still working. I couldn't believe that fucking Decker's phone call the other day. And I don't know if I'm allowed to use that F word, but I mean, maybe it applied to that quarter. It was just amazing. And it was just such a screw you to Nike, because they just Nike in every single way. They're like, yeah, we're having a hard time making enough of these super expensive. We're getting all this shelf space at the stores for. It's incredible. They didn't mention a thing about being ubiquitous at Paris.
So wait, if it's Nike keeps losing share, is there a bait, like when these things happen, when a company loses market share, do they just keep losing market share? Or is there like a point where there's like a base level? I'm always wondering about that. Or is it just like you gain share and then you lose share? Or, you know what I mean? How does that work?
They're going to have to release something. I mean, it's nudge them with your toe and see if Nike's still alive. If it was a wrestling match, this is the point they'd be lifting up Nike's arm, and letting it flop to the ground to see if it was still alive. They signed Caitlin Clark for 8 years, $28 million, and they don't have a shoe for her. On holding signed Zendaya, and they've got the best website I've ever seen in my life for an actress who played a tennis player in a kind of weird movie. It's like, which company's doing the marketing here? It's amazing. She's good in everything. She looks incredible in this.
I like her.
What a good idea to have the people you sign for sponsorships have related product that you sell on their behalf. I mean, Nike has no Caitlin Clark product. That's insane. They signed her in April. They do nothing but manufacture shoes. What the sweet hell are you people doing besides talking about innovation on conference calls?
All right, here we go. The clock is at 0. Welcome to Wall Street Beats. My name is Ben Brey. I'm here with Jeff Macke, Mr. Retail, Berna Barshay, and the well-dressed Robert Marcin, our local Philadelphia Eagles fan. And we are here to bring you a Shoe Focus Friday. Let's kick it off with talking about Deckers and Jeff Macke.
We got Deckers, we got On Holding, we got just the trade of the year, Ben, as we've talked about it before, and I talk about it endlessly because it's mine, and who doesn't like talking about their own good trades? But it was just get short Nike and get long almost everyone else, because it's Nike found themselves in a position, and we noticed it really started a couple of years ago, but they just got so kind of caught backwards and out of style and off trend. It really created this enormous opportunity for Deckers with their Hokas, for On Holding Group, the Swiss concern. Normally you pay no attention to a company that is just going to be an athleisure fashion house company like On Group. It seems like a company you'd want nothing to do with. But they keep stealing share, and they keep kind of hitting the cover off the ball with their core product, which is running shoes. And so we were laughing before, when Deckers comes out, and they were everything Nike was not. If you would have listened to Nike, you wouldn't think that a universe like Deckers existed, because all they could talk about is how Hoka was just cleaning up everywhere they went. They couldn't sell enough of it to the vendors who want it, because they're selling full price shoes for $300-something in a world where Nike has no growth whatsoever. Nike pays for Caitlin Clark to be a sponsor for them. They don't even have a product out for her. Caitlin Clark's like literally the only basketball player you can name. So it's created this great opportunity. You got a $15 billion company. The numbers are unjustifiable. And the only way they get to exist is to have the tailwind of Nike collapsing. And that's going to give them 30% growth, 40% growth next year. They're diversifying into enough things that, there's this skinny window of opportunity that it might be realistically valued. Obviously, that growth doesn't continue forever, but they're going into a lot of different categories, and they're really kind of going outwards from shoes the way Lululemon went outwards from yoga tights to become their own sort of brand, their own house brand. One of the things doing it, these guys are public. This stock's worked all year. Someday this party's going to end. It's not going to be this day. So I'm still long on Cloud and kind of resting in it.
So when I think about shoes, I go back to my early days and remember when Crocs was the hot stock, and then basically Under Armour had come out of nowhere and was taking share, and honestly you have the movie about the history of Nike with Michael Jordan signing, right? So how do you think about these companies that gain share, lose share in a cycle perspective, or like they can't get it back together? Maybe because you have a unique ability to talk about the consumer different than a lot of analysts. Then it's not just the numbers, it's like how they're running the business and how they're connecting with their customer. Like, talk to that a little bit. Like, is Nike going to go away? They lost golf, they lost this, or is there a way they can reinvent themselves?
There's absolutely ways they can reinvent themselves, but they've got to get out of their own way. They really have to. We mentioned the Caitlin Clark thing before, and it makes an interesting anecdote, and I'm sure they would give me 5,000 different reasons that they didn't actually come out with a product for the most famous women's basketball player in history, who they paying $28 million to. I'm sure they could give me excuses all day for why that is the case. But holy shit, do they need a manager to come in and say, what we're going to do is we're going to come out with a Caitlin Clark shoe, and we're going to sell 10 zillion of the damn things to every freaking girl that plays basketball in the United States. And it turns out there are millions and millions of them. That's how you start fixing Nike. Nike's just got to get their head out of their ass. They still have the best infrastructure. They just have a very strange culture where they keep losing share. In a lot of ways, they gave it away for DTC, which they like to blame. But also, what's the fixation with Michael Jordan? Like, he doesn't resonate with people under 40. I'm sorry, he wasn't that likable a guy to begin with, and they have everything named after him, and they're just kind of stuck with these brands that are kind of not old enough to be vintage and not new enough to be culturally relevant.
So they're in a weird spot then, right? They were the dominant brand for sports during the Michael Jordan era, which is, I agree with you. It's coming to an end. And he was always a dick, that's for sure. I'm going to openly say that. Best basketball player of all time, but not a great guy. And so is there a point where you have to reinvent yourself and then leverage that infrastructure? or do you just where's that pain point where they finally come to Jesus?
You would think they were there. You would think that they would be, and we just got a new CEO, and he's got to come in and make some changes. But I would really start with killing some sacred cows, which brings us back to Mr. Jordan. And this is just not a fashion brand that's worked. And the Nike really they should have been good enough to kill Lululemon in the crib, either by buying them or taking over that tights business. You're selling athletic wear to the masses. That was Nike's entire thing. And they just kind of let Lululemon become this 30 billion, whatever they are, size market cap company, right? While Nike was just sitting there doing nothing.
All right. Well,
Robert,
on your winners, Jeff, do you sell these on the way up, or do you have no idea how long these growth spurts can run for companies like On? And do you just ride it until in your mind the movement is peaking, the growth spurt is peaking?
On is a bumpy ride. The companies like this, foreign operation, you get to hear very little from them, only occasionally. I love the calls. I pay a lot of attention to the calls because I need them executing so hard. Like they have to be crushing it. There are plenty of companies that have gone into apparel thinking, holy crap, they love our shoes. We'll become an apparel company, and just hit the wall at freaking 500 miles an hour, which frankly is kind of what I thought would happen with On Holdings as they went into clothing. And sure enough, the first releases weren't great. They got immediately much better at clothing, super fast. And they're seeing a lot of success and kind of branching out. So they have to prove it to me every quarter. It's my fingers on the trigger pretty much all the time, because the last thing you want to do is let a winner like this blow up right while you're sitting there watching it, and it'll seem so obvious in retrospect that, it's the kind of thing that old traders, you get old really fast as a trader if you're going to be holding these On Holdings and not paying close attention.
Yeah, and this is like 26 times forward EBITDA, right? So this is not a cheap stock by any means. So
No, there's no room for slippage. There really isn't. And if there weren't a lot of ways to grow in a lot, and again, we're talking about a company that's been long for a while, and it's been a bumpy ride, and you're going to get rides with these things, but they still overall are growing, and so if your mistakes are, you get a 30% growth rate, a 35% growth rate, and you have this bloated corpse of a company that has just enormous $50 billion worth of market share that you can kind of pick away at in the form of Nike. It's a nice tailwind. It turns out definitely. It's a nice place for them to fill. It's a good slot.
I mean,
Berna and I have been talking all year.
Yeah.
Oh, go ahead.
Yeah,
not only are you picking away at the market share, but you also have, you're picking away the market share of not only Nike, but you're picking away at the market share of brown shoes, because the whole athletic category keeps growing as a percentage of spending, or the comfort category, because Robert's going to talk about Skechers, I'm going to talk about Crocs, which play into the same thing. But I've got a closet full of high heels that I we'll pull them out like 4 times a year. Now, part of that's, lifestyle changing, but everyone's lifestyle is changing, except for very few
people want to be more comfortable, right?
Yeah, people want to be comfortable. People are not dressing up to go to the office the same way. And, I remember, like 20 years ago, I was working at a startup and somebody walked into our office, like our intern walked in flip-flops, and like literally the whole office was making fun of him. But now, like I see people walking into JP Morgan headquarters, wearing Crocs, clearly they're not being ostracized for it, so.
Yeah.
Much more acceptable to wear ugly shoes today. So we should, we should
Well,
move that.
Our shirts like you, sir. You know what I mean? Like we're all keeping it comfortable. I got a hoodie on. All right, so let's move to Crocs. Before we start, I have a great Crocs story. The founder of Crocs, he's sitting on a beach in an island, and he created his first pair of Crocs, as the legend goes. Well, this guy was definitely a guy that could do it on his own. He got kicked out permanently for life out of the crosstown country club in my hometown of Madison, Wisconsin, for dressing like a lady at the member guest. So I know that this guy likes to, disrupt the industry. But anyway, so we're going to talk about Crocs with Berna. What do we got here?
Okay, well, I want to, I'm going to I'm going to talk a little bit about the HeyDude acquisition because it's such a headache for them. But first, you asked Jeff something about product cycles. And, it was a point that I wanted to make about Crocs and sort of the challenge they have with HeyDude ahead. But I think when you think about footwear, you have to sort of separate having a great product versus having a great brand. So a lot of companies will have a great product that will sell well, but having a great brand is what makes your corporation durable. It's why Nike, even though I've been very negative on it too, I would not bet against Nike coming back at some point once they have the product cycle with them again, because they do have a brand. So, separating a good product from an enduring brand is a little bit, qualitative. It's a little bit like, like what the Supreme Court said about porn, you'll like know it when you see it, right? But let me give you an anecdote about Crocs. Crocs, the Crocs brand, the clog. So I go every year to a investment conference in Cyprus and on the Greek side. And for the first time, I went over the border into the disputed territory that is occupied by Turkey and checked out what's going on that side of the border. What I found out is that it is like the Canal Street of Europe. It is every fake handbag, fake luxury brand, etc. Really good copies of Hermes, Louis Vuitton, etc. Had no idea that's what was going on there, but that's what it is. But what was interesting is one of the only fake brands there that wasn't a European luxury good was the Crocs clog. And so, it's costs like €4 or €5, or less, €2 to make the Crocs clog, right? And there are copies of it, unbranded Crocs-like clogs with the holes that you can stick gibbets in all over the Greek side of Cyprus and all over Europe that you can buy for €5. But people will go out of their way to go, get some fake Crocs that have the logo on them, for €15 instead of €40 what the real thing costs. Like, because it matters having the brand. There are a million, fleece boots that look like Deckers, that look like Uggs, but, it's not the same as having an Uggs because there's that brand value to it. People want the real thing.
Well,
and so
I think it's a big difference in the dollars though, right? Like if I get a fake Gucci bag, I'm saving $500, $700.
like
If I get a fake pair of
$2,000,
Crocs, I'm like saving $20. That's like a beer, So
But
like I might as well just get the real thing.
Well, that's what, but I mean, well, yes. And I mean, I think that's an argument for why the brand continues to do well, because like, even in tough times, like, Crocs, they had a giant slowdown in China where they only sell Crocs and not HeyDude. And they went from like 70% growth to 20% growth. But like Nike, Skechers, all these other companies would have died for 20% growth this past quarter in China. All the luxury goods companies would have died with the exception of maybe Miu Miu, but which did well. But, almost everybody went to zero or negative in China this quarter, and Crocs was still growing 20. And I think that's because it is the one chance where you can have the real thing affordable. But for people who can't afford even that affordable real thing, clearly it's a brand and not a product, because you can get the product without the brand, but people will go into a fake market and buy fakes of them the same way that they'll buy fakes of Louis Vuitton. So I thought that was an interesting story. So Robert,
what's the multiple on the stock now?
It's about 8 PE and about like 6.
Looking at it now on Bloomberg. So this is like basically the market doesn't believe there's any growth here. They just kind of like, hey, your peak earnings right now. Is that kind of what they're thinking?
Well, I mean, there's always been this company has the highest margins in footwear by a mile. So before buying HeyDude, they had 30% operating margins. Those are down to about 25%. Part of it from the planned dilutive effect of HeyDude, which probably was like when they bought it, a mid to high 20s, sort of 25 to 27% operating margin business. And now it's probably down around 18. They don't disclose it, so these are my estimates. But So the reason the stock was down 20% when they reported was not a miss on the Crocs side. The Crocs side beat. It is complete frustration with the fact that they bought this HeyDude company, which is a casual slip-on comfort boat shoe looking product. It is a product and not a brand. This is why I was talking about product versus brand. It is a product that was very successful in the Midwest of the US, the South. It doesn't really have much presence on the coast right now. Anyway, when they bought this company, they bought it at probably what looks like an expensive price now, 4 times EBITDA, and 4 times sales and 15 times EBITDA. Then the first year they had it, it grew from just under 600 million in sales, and then it was up like 50% that first year. So it got to 900 million, and so people were like, "Oh, it doesn't." When 15 times EBITDA becomes 8 times EBITDA for something that's growing 50%, all of a sudden a bad deal looked like a good deal. But then this year, the revenues have been down about 17%. And everybody was hoping, because this company, when they blew it out, they started distributing it using their leverage throughout the retail system to get this shoe better placed. And they overdid it, and there was too much inventory out there, and sales went down 17%, except it started in third quarter of last year. So I think everybody was really hoping this quarter that just reported was the quarter that the comps were going to get easier. And they basically reported the same kind of decline in third quarter as they did in second quarter. So they beat on the Crocs side, missed on the HeyDude side. The entire call was people beating them up because they say they're going to invest in HeyDude next year. They're signing deals. They have deals with Jelly Rolls, Cindy Sweeney. They're doing all sorts of collabs, and they're trying to turn this into a brand as opposed to a product, because much like the core Crocs thing, they have 1 or 2 silhouettes that drive the entire company. And so it's really a matter of, can they do it? And Robert had messaged me last night and said, this was a terrible deal. And I would argue that it's too early to say that yet. Maybe they overpaid. They probably did a little bit. But whether or not this is going to be a debacle, if they had grown sales 11% a year, 3 years in a row, instead of growing 50% and then going down 20%, people would probably be a lot more favorable to the deal. We have to see what happens next year, right? And is this impermanent secular decline?
The stock's 108 today. It trades at 8 times. It looks like $13 of earnings trailing 12 months. Maybe 14 is the out year consensus. Where's the buy case? Where's the multiple go, and where are the earnings at in a year?
Well, I think we're pretty close, unless something happens to the Crocs brand, which I don't see happening. I think we're pretty close to trough multiple, at least on a PE basis. So I was doing work last night that if they'd never bought HeyDude, but still had the debt that built up from HeyDude, then the stock, like on today's capital structure, just for the Crocs business, I think is worth about $100. So you're only paying about $8 now on 60 million shares. So you're paying, call it, 500 of EV for the HeyDude business, which is doing 800 million in sales this year. By the way, the depressed margin on this business is high teens, right? That is a neighborhood that, like, very few footwear, like, on its ass, HeyDude is earning a higher operating margin than almost any other it's higher than Nike's right now. It's higher than Skechers, than Steve Madden, than Adidas, than, name your company. On its ass, it still has a high operating margin. So that, to me, there's a lot of optionality there around that business doing better, and you're not paying very much for it at all. And meanwhile, Crocs has done this transition where I think it's gone from a product to a brand. I saw 2 people dressed up as Crocs last night for Halloween. I don't see people dressed up. You know?
The Crocs. And because I know the story, I know a couple things about that Steve, the founder. I just think it's one of the amazing things. All right, let me ask the other guys. Are you guys buyers of Crocs here? You guys buying Crocs? Do you like the story or not? Either one.
I find it kind of lazy. I'm actually wearing Crocs.
Go ahead,
Jeff.
Jeff
You did
first.
what, Robert? Okay, yeah,
ahead,
I'm
Jeff.
wearing Crocs right now. I love Crocs. You know, Crocs are going nowhere fast. They're a phenomenon.
Yeah,
I think the
Show
bearish case. What?
Show
What's
us your
that?
Croc. Show us your Croc.
I'm
You got a
happy
great
to.
Croc.
There we go.
I just
That's
got
a
these.
buyer and
They're,
owner right there.
see that?
All right, so
They're tartan on the inside.
Robert, tell
Yes.
me why I'm not going to lose my bet to Jeff. Where I'm just so the listeners know, I backed Robert with Skechers, not knowing much about it, just backing Robert, and Jeff took the other side with Long On and what was the other one, Deckers. And I'm losing badly. Jeff, I'm going to be doing push-ups in front of Jeff's house in the beach in San Diego sometime soon. So, Robert, update us on Skechers and let me have some hope that I won't be embarrassing myself in front of Mr. Retail.
Well, this is a race between the turtle and the hare, and you bet on the turtle, buddy.
That's a hell of a pep talk.
No, thanks for that.
That's reality. So Skechers is, for what it is, it's a very underappreciated, underrecognized global footwear brand growth company. And everybody dismisses this company. In fact, my story about Skechers is CNBC doesn't even know it exists. They were doing a story on the Nike miss, and they put up comparables. And Skechers is not on the screen because they don't know it exists. They had Foot Locker and Adidas or other companies up there, but they had no Skechers. And Skechers happens to be the third largest footwear brand on the freaking planet. And the CNBC
crazy.
doesn't know the company exists. So it's a company that's grown 12% a year organically with one brand, basically, for the last 10 years. And it trades for 12 times next year's consensus earnings estimate, which is stupid in a 22 PE stock market. Now, Skechers doesn't have any specific opportunity to explode sales and profit growth through a very successful product. Although the slip-ins feature that they put on their shoes, where you just put your feet in and there's a shoehorn built into the back of the shoe and it collapses over you, is a nice feature, and that's generating a lot of interest. But otherwise, their story is affordable comfort and quality, and they're an American brand that's taken a unique opportunity to distribute globally directly with their own stores, as well as a heavy component of outsourced stores where they license retailers. And they with 2/3 of their business international, the world's feet, is their TAM. And they're just starting to penetrate places like India and Brazil and Indonesia and the Philippines, Poland, South Africa, places like that. They truly are a global footwear company. And they're using the same strategy of hiring ex-jocks and ex-movie stars in their prime golden years to promote their products, and it seems to be working around the world. So not many companies
so it's really an international story, because I don't think that Skechers is a hot brand in America. I don't think it's a bad brand, but I don't think it's like, oh man, I gotta have Skechers. It's not like Viore or something or whatever.
It's like a Slim Jim, buddy. You either love it or you hate it. And a certain category of people wouldn't be caught dead in Skechers, but kids and old people like Skechers because moms like them for the kids, and then the moms, when they're old enough, like them for themselves and their parents.
It's so funny. I randomly said a Randy Macho Man Savage documentary come up on my YouTube the other day, and the nostalgia, I had to click on it. Step into a Slim Jim. But anyway, so Skechers is 12.5 times. Where is the stock? Like, tell this story of why am I buying the stock? Where's this going? Why? Give me the multiple and the earnings and where I could have as a framework of where it's going to go.
So they did $8 billion last year, $7 billion the year before, $6 billion the year before that. Next year they'll do 10 billion. Excuse me. So this year 9 billion. So 10 billion in 2025, off of around 9 billion. And the key to this story so it's cheap. You'll make 30%, 40% if nothing happens with their operating margin. Their operating margin, as Berna pointed out, is crappy. It's 10%. Now, they have fairly good gross margins. They do 53% gross margins, which is higher than Nike, I believe. So they're not making money on the gross margin level. These guys just never met an expenditure they didn't like, whether it was a factory or a distribution center or another, ex-jock that the CEO wants to party with. So they love spending shareholders' money. So with the 53% gross margins, they only bring down to the operating margin level 10%. And shareholders have been beating these guys up over the years, and they said they think they can get to a low teen margin when they decide to stop over-investing, and they call it over-investing for revenue growth. So if they keep growing around 10%, even if they grow 8 to 10% down from 12, and let that operating margin expand to 12 or 13% from 10, you would have a period of 20 to 25% EPS growth. So the $5 number goes to $6, goes to $7 in 2 years. So if you put a market multiple, even a 10 or 15, 20% discount, you should have a mid-teen to high-teen multiple on double-digit growth with 20% earnings growth, and with $6 and then $7 in 26 and 27, you should easily have a $100 stock. I mean, that's only a 15 PE on a $7 earnings estimate. But they have to consciously decide to leverage their revenue growth and reduce their SG&A as a percent of sales. And while they've said they will do it, they haven't shown any signs of dedication to that goal. So it's a much bigger stock if and when they decide that overinvestment is not the ideal strategy for the company.
So when I hear like all these three, like to bring it back to the focus of footwear today, I hear Jeff telling me On's doing really well and you're riding them. Now it's expensive. Crocs have maybe made a misstep in their investment, but you have full optionality on it. And then, Skechers is kind of somewhere in the middle, or they're like, 12 and a half times they're getting around, but they have a little optionality. If they get their act together, it can appreciate well. So let me ask the group. We talked about Crocs long, On long, Skechers long. Which, if you had to choose one, which one's each one of you choosing? Go, let's start with Jeff.
I'm taking Crocs. To be honest. It's
all right.
For the next 5 years, next 10 years. I just pulled up a 10-year chart of the Crocs and Deck. They're just animals. We're not just dicking around here. These are 10 baggers. So these are stocks that you can hold and get a little money out of. And Crocs they're just a margin beast. People have been trying to knock them off for years.
I mean, Crocs is my third biggest position, and the two positions that are bigger are like, S&P top 10, 15 companies that are, right, global stalwarts. So of my small mid-cap holdings, this is my largest position. So I trimmed some, at 140, I'm buying it back. I'll probably buy back even more than what I had sold. So clearly Crocs, but I think the other two ideas can work. I mean, I have trouble paying the multiple for an On just because I'm, I am a value biased person.
Value oriented.
Yeah, so I if I was buying a big multiple stock, it's definitely the one I would consider. But I'm thinking about maybe adding Skechers to my portfolio, but I have to go with Crocs because that's where my money literally is.
Robert, where are we at? What do you the
Skechers,
three? What do you
I'm long Skechers as a top 10 position, and I circled Crocs very aggressively. Didn't pull the trigger in the 50s and then again in the 80s. And in fact, I have a text message that when it was about 100, I told Berna it's worth 150, and the stock hit 150 up from 100 after I sent her that text. I still didn't own the stock, but I would hope in any pullback from here, I will become a buyer of Crocs for the fourth time in my life, and I've made good money the other 3 times.
Hey, look, that's a great trading stock. Both sides. You've had some cycles there. All right, so the take it away is we like Skechers. We like Anon taking share from Nike, and I think the favorite of the day was Crocs.
Crocs.
8 times earnings in optionality for a bad acquisition or questionable acquisition that the market doesn't like. And honestly, these guys are all great analysts, and you come follow us at Wall Street Beats. You can get more details on their thoughts, and join us next time. You have a happy Friday, and see you later.
And that's no crock.
Nice. Good job, Ben.
Thanks.
Really
Black
good.
Friday